Could this be the end of British family farming in the UK? We've seen thousands of farmers protesting in London against inheritance tax rules. So how bad are these new tax changes? I'm a chartered accountant from London and I help people deal with finances and tax. So let's take a step back and look at what's changing in terms of inheritance tax. The tax advice given to farmers is completely different from the tax advice given to other people. When it comes to inheritance tax planning, the goal for non-farmers and the large majority of people is to reduce the amount of taxable assets upon death. People are advised to gift their assets, use a trust, or spend their money, enjoy their wealth during their lifetime, all with the same goal to help reduce the taxable assets in their personal name. However, when it comes to farmers, they are advised to do the exact opposite and own their assets for their entire lifetime because they can pass on the farmland to the next generation without paying any inheritance tax. This is because at the moment, farmland is exempt from inheritance tax under a policy called Agricultural Property Relief, commonly known as APR. However, the Chancellor has just announced that this will end and she is going to restrict APR. The reduction in APR will mean that from April 2026, a tax of 20% will apply to agricultural assets over £1 million, which is, by the way, still a lot less than what everyone else pays at 40%. Because of the existing tax-free threshold for inheritance tax, two parents leaving a farm to their children could potentially extend their combined limits to over 3 million. Farms can be gifted early to avoid inheritance tax. However, some farm owners are old and unlikely to survive for 7 years. This sudden change in tax advice means that even if they gift the farms now, some assets will need to be sold to pay the unexpected tax bill. Farmers also benefit from BPR, which applies to other plant and machinery, including livestock. The £1 million allowance caps the combined relief that can be claimed under APR and BPR. Although this measure will impact only large farms, the tax collection through this method is unlikely to be anything significant. Farms will need to be sold, or some of the farms will need to be sold in order to pay the tax bill. And the government claims that they're doing this to generate the much needed funding for public services. However, it is unlikely to generate any significant sums of money. Some estimates are suggesting that it will only generate a few £100 million a year. And when we are talking about tax collection, it is not a lot of money. This money will not go very far to improve the public services, and it will damage food security, which is currently supported by family farming in the UK. We can expect a gradual food inflation and an increased dependency on imports. However, another interesting angle is that farms are currently being used as a method to park your money and to avoid inheritance tax. Due to these new tax changes, farms have now become less attractive as an investment opportunity, and they will definitely go down in value. And this could mean that with the new valuation, a lot more farms could be covered entirely or largely by the tax-free allowances. I hope you have found this video useful. Like and follow to stay connected, and do let me know in the comments, do you think it is fair to increase taxation on British farmers?